Our next guests have insight into what is doing for the credit markets, the private credit markets. We're joined now by Fortress Co-CEO Drew McKnight and incoming Oaktree Co-CEO Armen Panossian. Gentlemen, great to have you with us here by the beach. Drew, I'll kick it off with you. You say that credit is more interesting than equities right now. Why is that?
Well, I think anytime you can get paid high single digits, low double digits coupons and be at the top of the capital structure, your downside protection's much greater than equities, and I think you're getting equity-like returns.
A lot of people will say everybody and their brother getting into private credit, and that is of concern in and of itself, that there's some sort of bubble forming. Is that the case, or what would you say to that?
I think the demand for private credit actually exceeds the supply of private credit over the medium to long term. There's a lot of dry powder in private equity in search of private credit solutions, and therefore over a medium to long term period of time, I think that there's a big expansion opportunity in private credit.
Drew, we spent the last 10 minutes breaking down a bunch of earnings releases, so we're very granular. At 30,000 feet, what do you see that's encouraging, or maybe what do you see that's sort of scary right now?
Well, I think encouraging, credit markets are wide open, right? And I think the availability of credit is very healthy for the markets. That said, the cost of credit, given what's happened with interest rates and credit spreads, is not cheap. And so I think the cost of that capital is something that does need to reflect itself both in private equity multiples, but also in public equity multiples.
Armen, when you think about, again, we have this Fed meeting tomorrow, expectations for a rate move, not high at all, but as we think about March, that's going to dominate the conversation over the next month or so. Are we on the precipice of another regime shift as it relates to rates? And we've had a lot of volatility in yields over the last few years. And how do you guys think about that?
It's very hard to predict what the Fed will do. But I think there's enough data to support possibly a rate cut, but it really depends on what you believe will be the case in the economy at that point to precipitate that rate cut. I don't think you'll have to see a picture that's not that pretty for the Fed to move faster than what would otherwise be necessary maybe mid-year.
How would you characterize this coming year? Is it going to be sort of a sweet spot? I mean, it seems like we've got rate cuts coming. The economy has been slowed but not halted by any, according to any of the data that we see. So in terms of private credit, is that sort of like the Goldilocks scenario for you guys?
Well, look, I think because of the contractual coupons, it is an interesting place to hide where you don't have to get the rate cuts call right, you don't have to get the equity multiples call right, and still earn very healthy returns. I think what does give us some pause and some worry is the cost of capital in the real estate capital markets is still very expensive. And so I think the availability of credit in real estate, whether it's commercial or residential, like anyone who is trying to take out a mortgage right now, it's a lot more expensive than what it was. And so I think that is something that does give us pause. And I think a 25 basis point rate cut or a couple 25 basis point rate cuts is still very far from the cost of capital we saw in 2020 and 2021.
So do you see that as, I'm assuming that you see that as well in terms of the higher cost of capital in real estate, and can you sort of, play that out with what's going on in commercial real estate and the concerns that surround that sector?
I think the issues with commercial real estate are twofold. First of all, in commercial office properties, you have vacancies, you have a need for capital to re-tenant space, and the existing owners of that real estate are not really willing to provide that additional capital. I think the second issue is the maturity wall for commercial real estate, even outside of commercial office properties, is high and will continue to be high for several years. And with that escalated rate move over the last 5 years, there is going to be a need for additional equity capital or hybrid equity to fill that gap because deleveraging is necessary.
Drew, how important is what's going on with China over the last 6 months, but more specifically over the last couple of weeks in terms of their seemingly commercial real estate and real estate problems?
Look, I mean, just yesterday with Evergrande, I think it's very much top of mind. I think if you look at what's going on in that market, I think it's navigating a lot because they really don't have a bankruptcy regime. We invest in primarily developed markets because we're in credit, and our biggest focus is needing to actually enforce contracts. And China is really inventing that process as we speak, and you're seeing it playing out on something like Evergrande. I think it also affects everything we're doing. We had a panel earlier, we're talking about treasury auctions. How does that, China's a big player in our auctions, how does this affect the way they behave in these auctions?
Yeah, so Armen, I'm not going to you guys have been the higher for longer camp. And I know you said the last question you answered is I can't really predict rates, but the whole idea that for rates to go down precipitously, and at one point, Fed Fund futures were pricing in 5 or 6 cuts at some point this year. We debate on this desk, what would be the impetus for that to happen? Something not good for the economy, not good for risk assets, that sort of thing. On the flip side of that, though, and none of us are going to try to predict that. Higher for longer, what does that mean to you? Is it that inflation is a bit stickier, the economy is, like we have unemployment that stays below 4%? How do you guys think about that?
I think it's the Goldilocks scenario. Honestly, it's that there is GDP growth, but it's tepid. There's CPI that's sort of in line and not really problematic. That needs to you don't need to see a rate increase, but there's no real catalyst to actually reduce rates. And I think that in being in that Goldilocks scenario for longer than expected results in being higher for longer.